Today is Thursday, January 7th. This is a post-market review for the stock market activities today. What did we see in the market activities today? A similar story of yesterday, a continuation of the inflationary trade. However, we also saw dip buyers and quote-unquote bargain hunters buying momentum and tech names once again. Of course, there are some technical developments in the market and important activities in the options market, so we will cover everything per usual. However, before we start, let me say this. Yesterday, we all witnessed the chaotic scenes that took place on the state capitol in Washington, D.C. And the question was, not just from market participants, but even from retirees and people who don't usually watch the stock market. The first thing they did is to check on their stocks and how they're doing. And they were surprised to see that their portfolio is actually up significantly while all the chaos and destruction was taking place in Washington, D.C. and the nation was on its edge. The question right away is, how the hell does that happen? Shouldn't the Dow be down 1,000, 2,000 points? What's going on here? If you are a money manager, you certainly got some calls from your clients panicking and asking you what's going on, should we sell, etc., etc. Now, money managers will never advise you to sell at all because they make their living so long as you are invested in the market. They continue to charge you fees and make money. Taking your money out of the market, booking profits, that is not good for money managers and financial advisors. So they'll always tell you, don't panic, it's all right, the market looks forward, etc., etc. Keep your money in the market. And today we heard from money managers, market analysts, even billionaire investors coming up on television attempting to answer the question, why was the market up yesterday amidst all the chaos and uncertainty? And the answer they gave is, number one, the markets look forward, and when they look forward, they see more stimulus from the Democrats, more infrastructure spending, etc. But somehow magically, when the markets look forward, they stop at the point when Democrats are going to raise taxes. All of a sudden, the market becomes blind to that. Just look for what you want to look for. But the second reason they gave for the market's activities yesterday is TINA, meaning that so long as interest rates and treasury yields remain low, you got no alternative but to pour more money in the stock market. And market participants have no incentive to take profits off the table, meaning that the froth is justified. However, let's say the market tomorrow drops 2-3%, a big down day. The same geniuses will come over at television and say, oh, the market's selling off because there are pockets of froth in the market and uncertainty. Whoa, wait a minute. Yesterday, the market did not give a rat's ass about uncertainty and froth didn't matter, but somehow magically today froth matters. This is the bullshit, talking out of your ass kind of behavior that comes out of quote-unquote market experts on television, and they confuse retail traders every single day. There is a simple reason for the market's behavior yesterday. Take a look at the chart of the IWM, the small caps index, from a 15 minutes perspective. Markets move higher if there are more buyers than sellers. Markets move lower if there are more sellers than buyers. As simple as that. What did we see yesterday in the trading activities for the IWM? You see it right in front of you. Green candle after green candle after green candle. We started the day gapping higher. So there was an already algorithmic buying program that was triggered overnight. It was planned to execute ahead of time after the elections. The same story that happened after the presidential elections, what we call the quote-unquote mysterious entity that keeps pumping the market overnight. Similar story here. They pumped the market overnight. They unleashed a program, a very massive one, and you see it illustrated in the first box on the chart. You see big volume, pretty consistent. If you break it down to 1 minute, 5 minutes, it gradually tapers off all the way when we reach lunch time. You combine that with the fact that market participants, specifically retail traders, are now at the stage of euphoria, meaning that they saw the market face the COVID-19 crisis, death rising every day, infections rising every single day. We saw riots and chaotic scenes in the summer. We saw riots and chaotic scenes yesterday. We saw the presidential elections volatility and the aftermath. All of that happened while the stock market continued to go higher and higher and higher. That in itself emboldens market participants and gives them a reason not to sell at all. In the euphoric stage, you start to take maximum risk. You start to become complicit in the market. And this is exactly what market participants are doing. In a normal market, when you see a huge pump like we have seen in the IWM yesterday, it is usually an opportunity to take profits, not in this euphoric market. Back to the chart. Combine the upward force of algorithmic buying programs with the lack of selling from retail traders and market participants, and you have a perfect recipe for an impulsive move higher. Even if an asteroid hit planet Earth yesterday and life ended as we know it, life would have ended with the IWM up 4% for the day. And the reason is nobody was selling. So it doesn't matter if we had riots, nuclear bombs, asteroids, the market would have still went up when you combine the fact that we had a massive algorithmic buying program combined with a lack of selling. A similar story today, but we did not see the algorithmic program being launched during trading hours. It is back to how it's done usually during the overnight session. Now take a look at the retail volume and how low it is. What did we see in the IWM today? An overnight pump via the same quote-unquote mysterious entity that launched the algorithmic buying program yesterday. And it is the same mysterious entity that has been pumping the market overnight since post-presidential elections. They pumped the market overnight. Retail investors and traders are already all in. They got no more cash to pick up the tab and push the market higher. And you see right away the IWM, along with a lot of other indices, pretty much trading flat. Retail doesn't have the appetite, the money to push the market higher. They're already all in. The only retail participation going on in the market right now is spending the stimulus money in buying speculative names, call options, and I will illustrate that to you when we cover the activities in the options market today. But I hope this is a good explanation for you on why the market goes higher even though we have very negative news. Extreme, forceful pressure to the upside via algorithmic buying programs combined with the lack of selling. And I can already hear you asking the question, what will make market participants sell? That is the $1 million question. And to answer that question, we need a whole other video. So we're not going to waste any more time because we do have a market to cover. And here we go. The Dow Industrial Average closing in the green by 211.73 points, or a gain of 0.69%. The Nasdaq closing in the green and leading the day by 326.69 points, or a gain of 2.56%. Of course, the so-called bargain hunters who bought the dip in the Nasdaq today did not get the memo that inflation is rising. But again, recency bias, they're gonna do what they are accustomed to do until they are suddenly caught with their pants down. But if you're paying attention, you're not gonna be surprised when it happens. Moving on to the S&P 500, closing in the green by 55.65 points, or a gain of 1.48%. And here are the sector's performances for the day. Number 1, capturing the gold medal by far, technology. At number 2, capturing the silver medal, communication services. At number 3, for the bronze, consumer cyclicals. And you see that the inflationary trade from yesterday is still doing pretty good. Industrials, materials, energy, financials, all performing decently for the session. We're just playing catch up with the tech and momentum sectors. Meanwhile, the lagging sector of the day is utilities, down by over 1%. Moving on to the coverage of the futures market. And let's see what happened today. Right away, you see the most notable activity is that the dollar index managed to close in the green. It was a positive day for the US dollar. And here we see the divergences. We see oil up, metals up, meanwhile grains down. So grains followed the move in the US dollar. The dollar goes up, grains go down, and so should metals and oil. But instead, they closed in the green today. What's up with that? It could be a lagging reaction, or it could be the fact that the US dollar is just rallying based on short covering from people who shorted pre the Georgia elections and did not get the impulsive reaction to the downside that they were looking for, and therefore you see metals and oil not taking the move of the US dollar today seriously. So we will see if this is a lagging reaction that will appear perhaps tomorrow or next week, or if this is just a one pop for the US dollar and metals are right here, not grains. Anyhow, the WTI closing in the green by a little over half a percentage points. Moving on to softs, underperformance from sugar, significant one, down over 3.5%. So did coffee and cotton. However, we see OJ, coca, and lumber closing in the green. Moving on to metals, everything closing in the green, exception palladium. And of course, we see gold being the mature guy in the room here, not rallying impulsively, unlike Dr. Copper and Mr. Silver. What about grains? Declines to a muted action, but we saw significant losses here for soybean, meal, oats, and canola. Moving on to the big casino, the options market, and let's see how the tables did today. Number one, and before we start, by the way, the action that we saw in the options market today is indicative that a lot of Robinhood traders got their 600 stimmy and they're spending it on call options. There was a significant uptick in the call option activities, specifically in the Robinhood crowd's favorite names. We're talking about Plug Power, Fuel Cell, etc. We'll talk about that in a little bit, but keep that background in mind because you can see the effect right away from Tesla's numbers. Coming up, number one, with over 2.5 million contracts, unbelievable number, 62.5% of those were calls. Now, do me a favor, please, and look at the trading volume of Tesla stock today. You know what? I'll do the favor for you. It was a little over 51 million shares traded today, which is around normal. So why the hell is Tesla up almost 8% for the session? Look no further than the action in the options market. 2.5 million contract, which is the equivalent of 250 million shares. You compare that with the fact that Tesla had about 50 million shares traded today for the stock. Meanwhile, the notional value of the options traded is 5 times larger. This is the insanity of La Land that we're living in. They're trading more options than the actual stocks traded for the session, meaning that all of these pumps are temporary, and for the short term, you're going to see the pump and then the dump will come later. And we will be able to spot it, by the way, doing the technical analysis and watching how the options volume is going to recede. So it's very important if you are a top hunter for Tesla to watch the options volume and the development from this point on. Back to the casino. Number two, Apple with 1.6 million contracts. About 74% of those were calls. And here is the surprise. AT&T with 700,000 contracts, almost 91% of those were calls. Something is brewing here for AT&T. Switching to the unusual activities for today's session, right away you see the Robinhood favorite names catching some bids from the stimulus money. Right away we see the ticker plug for Plug Power, and they're buying the 50 calls. Expiration date, you guessed it, tomorrow. Easy money, easy come, easy goes. They're not even thinking about spending it right. Because in this case, they're expecting that Plug Power would rally over 6% by tomorrow, and they are paying about 70 cents a piece to enter this trade. Now, here is another one for the Robinhoodiots' favorite names, the ticker RIOT, Riot. And this is, by the way, not a bullish bet for the rioters in Washington, D.C. last night. It is actually for Riot blockchain, and this is a bullish bet for Bitcoin. If you're too poor to buy Bitcoin, you might want to look into this one. And they've been pumping the name over and over and over, and you see them pumping it even more today. Buying the 24 calls, expiration date next week, January 15th, with expectation that the name would rally over 5.5% by then, and they are paying about $2.65 to enter the trade, bringing the total to over $6 million. Here is another notable one for the ticker WFC, and this is for Wells Fargo. We know that after the Democrats win in Georgia, we're seeing this inflationary trade which will benefit banks, and here is a bullish bet for Wells Fargo. the shittiest bank of them all. They're buying the 36 calls, expiration date February 5th, and they're expecting the name to rally over 8% by then, and they're paying about 62 cents a piece to enter this trade. Here is another interesting trade for the ticker FCEL, Fuel Cell, another name that is very popular with the Robin Hoodiots. And in this case, they're buying the 14 bucks puts, expiration date next week, January 15th, with expectation that the name will decline over 6.5% by then. They're paying about $1 a piece to enter the trade, bringing up the total to a little over $1.5 million bucks. We see more bullish bits here for Taiwan, the ticker TSM. This has been a very consistent theme, so we're not going to cover this one. You've been seeing bullish bid after bullish bid for TSM. It is an excellent performer and one of the best performers last year. It will probably continue to be one of the best performers in the semiconductor sector. But you're also seeing a bullish bid for AMD, and they're buying the 110 calls, expiration date January 29th. They're paying about $1.45 to enter the trade, bringing the total to about $2 million bucks, and they're expecting AMD to rally over 15.5% by then. Now, here's an interesting name, the ticker MARA, and this is for Marathon Patent Group. What the hell is that? This is one of the Robin Hoodiots' favorite names. Somebody spell out the ticker on Reddit or TikTok or YouTube, whatever channel they use, and they go all in Naruto style, buying the same name, buying call options, and you see the MARA, the ticker MARA, was up about 32% today alone. It's been running hot for the last few days. It went from about 10 bucks to now about 22 bucks. Unbelievable move. And it shows you the power of gamma squeeze when everybody stampedes all at once buying call options. You're forcing option sellers to buy the underlying stock, and that causes the name to rally impulsively. But here's somebody calling the top, and they're buying the 20 bucks puts, expiration date January 15th, meaning next week. They're expecting the name to go down over 10.5% by then, and they're paying big bucks for this one, about $2.60 a piece, bringing the total to over $3 million. Here is another one for Alibaba, and they're buying the 245 calls, expiration date January 22nd, with expectation that Alibaba is going to rally 8% or so by then. They're paying big bucks again, about $2.70, bringing the total to over $3 million. Now, if you're betting on a rebound for Alibaba, you gotta do it this way, via call options, because if you commit a lot of capital to buy the stock and then we see more bad news, you're going to be holding the bag for a while. Take a little bit of risk, buy call options, $2 here, $3 there, and if the name rallies and it's out of the woods by expiration date, you exercise your option and you buy the shares. Now, here is one for Micron, the ticker MU. They're buying the 88 calls, expiration date next week, January 15th, with expectation that the name is going to rally over 11% by then. And they are paying about 80 cents a piece to enter this trade. Now, Micron, I believe that they reported earnings after the bell, and the name is up about 2.5%, or excuse me, about 1% after the bell, and it is trading around 80 bucks. So again, it could be somebody buying a lottery ticket and they're just looking for alpha to be in their side. They dump the options tomorrow for a little bit of profits, and it could be also a shareholder of Micron, and they're trying to raise some cash by selling upside calls. And if the name rallies all the way to 88, they got no problem of their call options being exercised and having to sell their shares at 88 bucks a piece. And here is the last trade of the day that I'm covering for 3D Systems, the ticker Triple D. And again, to illustrate to you the whole stimulus Robinhood crowd, it's going into the options market, and 3D Systems rallied over 100% today. The name doubled in a single session. The reason is the stimulus money is chasing the typical young investor Robinhood crowd kind of names. The EV names, energy, green energy names, plug power, etc., 3D printing, all the new trends that they're chasing. And this is no different here. Even though the name is a shitty name, it's been around for a long time. And of course, you combine the gamma squeeze in the options market for the name with the fact that the company announced today that they're selling some of their core businesses, and you see the name rallying over 100%, pretty much doubling for the session. Moving on to the headlines that shaped the day, starting with macro news. And right away, we heard about the weekly unemployment claims coming up at 787,000 applying for unemployment benefits last week. It is a little lighter than expected, which is good, but again, the crisis started back in February of last year. We're almost a year after the pandemic crisis, and we are still losing 700 plus thousand jobs every single week. And of course, remember, we have the big jobs report coming tomorrow. That would have significant implications for the market. We will discuss it during the conclusion of this video. For now, moving to the ISM Services Index. We talked about the PMI Services Index yesterday being disappointing. Well, the ISM is a different story because it showed a surprise to the upside. Unexpected increase for the ISM services in December to 57.2 versus 54.5. That's the estimate, and 55.9 was the reading for last month. New export orders, business activity, and new orders stronger. However, supplier deliveries reflecting further supply chain disruption and unemployment now contracting. So again, we will see further clarity along the line whether the PMI or the ISM Services Index is telling the truth. Moving on to trade deficit, and here it is, nearly a record trade deficit reached in November at minus 68.1 billion versus minus 67.3 billion. That was the estimate, and minus 63.1 billion for the prior month. So the trade deficit is increasing month over month, and now worse than the depth reached in the 2008 and worst since 2009. And the reason is we had 2.9% increase in imports versus 1.2% increase in exports. And perhaps this will improve as we start to reopen and we see if the manufacturing PMI and manufacturing ISM surveys are correct next month or not. And we also had some updates for market sentiment. Here it is. Citibank downgrades U.S. stocks, predicting that global equities will be flat in 2021, except in these key markets. And spoiler alert, it's the same names that I've been preaching to you: emerging markets, value, etc. But how come Citibank did not get the memo from the Laundromat, JP Morgan, Goldman Sachs, etc.? You're supposed to pump. You're not supposed to scare investors away. You're supposed to say 2021 will be the best year ever. Put your blindfold on and continue to buy. And perhaps these amateurs at Citibank should learn from their colleagues at Goldman Sachs, because Goldman Sachs came out on Monday and they said, look, heads we win, tails you lose. Whether the Democrats or the Republicans win, Wall Street will win as well. And if the Democrats win, it's actually going to be better because stimulus will increase. And they gave us the number $600 billion. Well, apparently the folks at Goldman Sachs felt that the pump from Monday earlier in the week was not enough because, as I illustrated to you, retail participation in picking up the pumps from the big guys is not happening. So what did Goldman do today? They upped their stimulus estimate from $600 billion to $750 billion. How about we go 1 trillion? Why stop at 750? Again, a memo to Goldman Sachs, Citibank, Wells Fargo, Morgan Stanley, etc. You guys are supposed to pump to extremes. You're supposed to create bag holders. That is your job. Don't say 700 billion. Say 700 trillion instead. Make it a little more believable. And speaking of Goldman Sachs, here it is. If you guys missed on your success from buying the DoorDash IPO and the Airbnb IPO and the Snowflake IPO, here is a new lottery ticket for you to chase. Instacart taps Goldman Sachs banker as CFO ahead of expected 2021 IPO. And rumor has it, Instacart will IPO at the valuation of $2 trillion because it is the future, bro. But why do you amateurs continue to chase these names, Snowflake, Airbnb, etc., and you lose your money? The smarty pants, aka me, I'm buying Goldman Sachs instead, because heads, Goldman Sachs win, tails, Goldman Sachs win as well. They don't give a rat's ass whether the IPO is successful or not. They're gonna get paid any ways. Goldman Sachs is a monster, and when they report the fourth quarter earnings, you're gonna be stunned of how much money Goldman Sachs made from all of this market mania by Goldman Sachs. And moving on to Federal Reserve news. We know that a lot of Fed speakers have been speaking this week. And here is the party pooper, Philadelphia Fed President Harker. And he said the Fed may cut its monthly bond purchases as soon as the end of this year, joining the Atlanta Fed President Raphael Boystick. Again, do I have to spell it out for you guys? You're not supposed to say that. You're supposed to say, don't worry, the flow of cocaine will continue to happen. Matter of fact, we're going to increase the flow of cocaine, not cut it by the end of the year. That's not good. Otherwise, the market is going to suffer a withdrawal. But if you are disturbed by the imbecile remarks of Philadelphia Fed President Harker, rest assured we have an ally on our side, and this is my favorite Fed president, the St. Louis Fed President James Bullard. And I warned you yesterday that James Bullard is gonna say crazy stuff. So here it is. Fed's Bullard says inflation may be higher than what we are used to this year. Whoops. I guess Bullard is also slipping here. You're not supposed to say that, Mr. Bullard. You're supposed to say inflation is very low and it requires us to do more accommodative tools to increase inflation. But here it is, an admission from the most bullish Fed president saying that inflation is, a little higher than we expected. Who told you that ahead of time? This channel. But here is Bullard pretending to be a doctor, and he said that coronavirus vaccines mean health crisis is expected to wane in the months ahead. And he sees continued U.S. economic recovery in the first half of 2021, and in the second half of 2021, he sees the market to the moon, bro. Moving on to give you an update on the whole Washington, D.C. events yesterday and what happened with Trump. Aftermath. Here it is. President Trump committed to the orderly transition of power on January 20th, shortly after Congress certified Joe Biden's election win. But the damage was already done, and here it is. We heard from Facebook right away in the morning. Breaking: Facebook bans Trump indefinitely, and the slew of bans kept on rolling. Here it is. Shopify takes Trump organization and campaign stores offline. Furthermore, here it is. Twitch disables Donald Trump's account. Now, I was looking forward to watching Donald Trump playing the League of Legends. I was looking forward for his live stream from the White House, but unfortunately, it's not going to happen. And by the way, to join all of these tech companies, the Maverick Wall Street channel has decided to ban all Trump memes indefinitely. Moving on to Trump Jr. And no, we're not talking about Donald. We're talking about Elon Musk, also known as Reverend Elon Musk. And the Rev had a lot to say today, perhaps for a valid reason. Here it is. Elon Musk took a swipe at Facebook after the attack on the Capitol, saying that the riots were the results of a domino effect stemming from the social network's creation. Furthermore, here it is. Reverend Elon says that WhatsApp is forcing users to share personal data with Facebook, and Elon Musk is urging people to switch to Signal, a smaller, encrypted messaging app. And of course, the Elon culties immediately stampeded to download the app. Matter of fact, the app crashed, and the Robin Hoodiots were searching for Signal stock, and they bought the ticker SIGL, a company called Signal Advance, which has absolutely nothing to do with the app Signal that Elon Musk recommended. And the Robin Hoodiots managed to push this stock over 500% for the session. That is the power of dumb money. Can Reverend Elon hype up our channel on YouTube? We will have 1 million subscribers right away. Maybe I should start being nice to Elon Musk from this point on. And there is a valid reason to be nice to Reverend Elon, because here it is, the biggest news of the day. Reverend Elon Musk passes Jeff Bezos to become the richest person on Earth. And by the way, what is the richest person on planet Earth doing? Here it is, tweeting memes about his cock. Moving on to another billionaire who's trying to take advantage of dumb money, Chamath Palihapitiya. And this guy, of course, is portrayed as the good guy in Wall Street and Silicon Valley. He's just your average Joe who happened to become a millionaire. Or billionaire, excuse me, no offense. And Chamath Palihapitiya did an interview with CNBC earlier in the day where he said that Tesla stock would double and Bitcoin is going to 200K. Of course, Chamath is pumping so dumb money can stampede and make him richer so he can dump on their little heads just like he did with Virgin Galactic. And here is just a rewind to one of Chamath Palihapitiya's best calls. Remember 2 years ago when he said that Box is his best idea? Box is down since that call. But sure, Tesla's going to double and Bitcoin is going to 200K. Make sure you follow this advice and make Chamath Palihapitiya even richer, because all the SPACs that he's doing, that's not enough money. He needs to exploit all the dumb money available right now in this bubble and take advantage of that. And I do not blame him at all. We all would do the same thing if we were in his shoes. No empathy for dumb money whatsoever. And now let's talk about the last bit of news we have, and it is the main subject of this video. Let me play this video, which is the most important statement ever said by a Federal Reserve president. I will continue to play this video for you every single day because it is the statement of the century, and future generations will go back to this statement when they study the history of the stock market. Here it is.
And I think you'll find a mixed bag there. It depends with equities. It depends on whether you're looking at PEs or whether you're looking at the premium over the risk-free return. If you look at PEs, they're historically high, but in a world where the risk-free rate is going to be low for a sustained period, the equity premium, which is really the reward you get for taking equity risk, would be what you'd look at, and that's not at incredibly low levels. So, which would mean that they're not overpriced in that sense. Admittedly, PEs are high, but that's maybe not as relevant in a world where we think the 10-year Treasury is going to be lower than it's been historically from a return perspective.
Now, your boy Jerome, Papa Jerome, is saying stock valuations are too high and excessive, but you got to put it in perspective here because they are cheap when you consider that there is no alternative but to buy stocks because the Treasury yields are lower, specifically the 10 years Treasury yield, and they will remain low indefinitely. Now, here is the part of the video that everybody missed and nobody talked about.
So the broad financial stability picture is kind of mixed, I would say. I would say it's, asset prices are a little high in that metric in my view, but overall you have a mixed picture. You don't have, a lot of red flags on that. So, and it's something that we monitor essentially ongoing, almost daily. We're monitoring these prices for that and have published our framework, and we'll be held accountable for what we saw and what we missed. So we work very hard.
Did you catch that? You and me are just lab rats for a big experiment from the Federal Reserve. They're creating one of the biggest bubbles ever in history, and they're trying to justify it because the trajectory for 10 years Treasury yields are going to be lower. And if that doesn't work and the market crashes and we have another financial crisis, whoops, it's just an experiment. We will take notes and study them and see what we did right and what we did wrong, what we missed and what we didn't miss. That's cool. Now, you don't have to wait till that day to figure out what the Federal Reserve is going to miss. Here it is. A big argument to buy U.S. stocks now at such high valuations is their value relative to extraordinarily low bond yields. As the Treasury yields rise, that advantage gets diminished. I'll read that again. As Treasury yields rise, that advantage gets diminished. Right now, the earnings yield on the S&P 500 is the lowest versus 10-year Treasury yields since 2018. Why is this important? Because we've been covering news after news, macro indicators, all showing that inflation is about to have a massive surge. A surge in inflation will guarantee that the 10 years treasury yield will climb higher. This week alone, we managed to climb over 1% decisively, and you saw the impulsive movement in the last 2 days. As the 10 years treasury yield continues to rise, we are going to have to cut the multiples because the risk premiums are not going to be as worthy as they are right now. Matter of fact, the risk premium is not worthy when you compare it to 3 months ago. And here is the monthly chart for the TNX that tracks the 10 years treasury yield. Right away, you see that we have been on a downward trajectory, and we had some of those fake outs where everybody thought that the bond bubble is going to bust and treasury yields are going to start to rise once again. It did not happen. So why is it that this time is different? Number one, take a look at the monthly chart of the TNX and take a look at the crossing we're about to make in the MACD indicator, signaling an upcoming strengthening in the momentum upward. And the reason why this time around is not going to be a fake out is due to the pandemic. It changed everything. Every attempt to pop the bond bubble and rally yields have failed in the past because it is just like trying to crack up your engine when you're out of battery. You do it, you get close, but it never happens. You need jumper cables and another car to do it successfully. Well, the pandemic is the jumper cable here, and the reason is the pandemic and the aftermath of the pandemic will cause a significant increase in inflation. Here is the chart of inflation, or the ETF that tracks inflation expectations. We've been on a downward trajectory since the very beginning. Things are changing now. Inflation expectations are rising in an extreme bullish trend. It is moving away from the bearish descending trend and trending higher instead, meaning that unlike previous attempts, this time, the rise in treasury yields will be successful due to the rise of inflation. Just take a look at the rise in input prices, commodity prices, asset prices, oil prices, housing prices, and even now, the most bullish Fed president, James Bullard, is admitting that inflation is increasing higher than even the Fed expected. And this is why the chart of the 10 years treasury yield is the most important chart in the stock market right now. If we continue on the upward trajectory impulsively, you bet that the stock market will crash because the risk will not be worth it anymore. You got to contract the multiples. Are you paying attention or not? The likelihood is you're not, because you're enjoying the bubble right now. You indulged in it, watching your gains grow day by day. You're not paying attention whatsoever. I'm trying to show you the blind spot in the mirror. Moving on to the heat map analysis, and we're going to go a little faster here because we're running out of time. As you can see, it is a sea of green with very few exceptions, and the theme is a continuation of what happened yesterday, plus this time around tech and momentum joining the party. Yesterday, we left them out of the party. Today, we felt bad and we picked them right up due to dip buying from the retail crowd. Technology, pretty much every single name managed to close in the green decisively. We saw very impressive gains, specifically in the semiconductor names. Communication services, similar story, specifically with the bigger names. Google and Facebook, the hottest names, the IPO names, Dash, Airbnb, Spotify, all of these names managed to outperform significantly. Moving on to consumer cyclicals. Tesla, we know the story. Stimulus money showed up in the options market. Tesla goes higher. Amazon muted, interestingly, and we saw Alibaba was declining a lot in the morning but managed to climb back pretty much to the flat line. But again, all these sectors that managed to outperform yesterday, they continue to outperform today, but we saw the momentum names that got dumped yesterday being picked up once again today. We're talking about NIO. We're talking about Li Auto, up over 10%. Xpeng, up almost 10% as well. What about consumer defensives? Not so hot so here. These names are usually become very favorable when we have low interest rates environments, specifically in treasury yields, because these names offer high dividend. But we see Procter & Gamble down, Coca-Cola down, and the outperformance remains from Target, Monster Beverages, and Constellation Brands. Constellation Brands, the ticker STZ, was up over 2% for the day. Moving on to REITs. Rebound day for American Tower, Public Storage, but we see weakness with residential, healthcare, retail, office, and mortgage REITs. What about utilities? They managed to get away with an outperformance yesterday. Today we caught them. They're not going to perform very good, but we see the treasury yields climbing higher. Dominion Energy down, Duke down, Sempra Energy down big, over 3%. However, the notable outperformer for the day is Next Era Energy, the ticker NEE, managed to close in the green by 1 percentage point. What's going on here with basic materials? Similar story. The hot run in Freeport-McMoRan and copper names goes on. The ticker FCX, my second largest holding, one of my favorite names, is up again, over 3.3% for the session. It's getting a little ridiculous here, specifically with the fact that the US dollar managed to rally today just a little bit. So perhaps we are nearing a top in the rally for copper here, specifically Freeport-McMoRan. How do you protect your shares? If you have some, like I do, you buy put options and that will give you protection. I'm looking for about 2 to 3 months from now. And we see another name, Valley, climbing over 4% for this session. Moving on to industrials, what do we see here? A similar story of yesterday. Pretty much every name closing in the green. The most bullish names are going to be Caterpillar and Deere. These are the most beneficiaries from the inflationary trade when we talk about Democrats taking office and spending like a drunken sailor. The pockets of weakness here came from Triple M and the defense names Lockheed Martin, Northrop Grumman down over 2% for the session. Again, Democrats win means less defense spending. These names continue to go down. We also have notable underperformance here from FedEx. And if you recall, we covered the chart of FedEx a few weeks ago and I said that FedEx is a short from this point on. And you saw the name declining significantly since then, and today was no exception. FedEx down over 2%, almost 3% in the red. What about energy? Not as hot as it was yesterday, but again, you see my favorite pick here, British Petroleum, BP, up over 2% for the session. It was a decent day for healthcare. We saw healthcare insurers rallying once again. As soon as we have certainty of who's in charge, these names don't care. They donate to Democrats and Republicans alike. They're going to keep the racket going on for years and years. As far as biotech, we saw an outperformance from Vertex, Regeneron. However, Moderna, the outperformer from yesterday, is underperforming, down about 1% or so. The biggest winner in the drug manufacturers is Merck, up about 2 percentage points or so. And then we have some notable outperformance here from Thermo Fisher, one of my favorite names, up over 3%. And here's another one of my favorite names as well, Edward Life Sciences and Medical Devices, up over 2.5%. What about financials? The rally in banks goes on. JP Morgan up over 3%, Bank of America up over 2%. But the notable outperformance here is from regional banks. And by the way, when we talk about yields, a lot of you are going to say, should I buy the KRE, the regional banks ETF? You could, but again, not all regional banks are created alike. When you buy the KRE, you're buying garbage within, the good, the bad, and the ugly. I'd rather go with the good by itself, and in this case, it is the ticker USB, US Bank Corp, is my favorite name in regional banks. And as you know, Warren Buffett owns this name and continues to add to his stake in US Bank Corp. The name finished up 2% for the session. But the notable outperformers here, per usual, Morgan Stanley, Goldman Sachs, and PayPal finishing the day over 3.5% in the green. Notice that every single dip in PayPal is being bought. Moving on to the rotation trade, and let's see what happened today. As you can see, the stay-at-home names, the momentum names managed to outperform for the day. But it is not a definitive theme, meaning that the momentum names are just playing catch up from the action yesterday. We see the biggest gainers: Tesla, Shopify, Google, Peloton up over 7%, DocuSign, Nvidia. Meanwhile, the biggest loser is FedEx. Across the aisle, we see modest gains for the reopening trade, notably from Royal Caribbean, over 2% for the session, but we saw losses as well from American Express. American Express is under investigation. Coca-Cola down, also under investigation. MGM Grand not under investigation, but happens to be down. Moving on to the charts analysis, and let's see what's going on here. Starting with the SPY 15 minutes chart. Right away, you see the pump overnight. The program takes place overnight, and it lasts for about the first hour or so of trading, and then it goes off, hoping the retail traders are going to pick up the tab. Retail traders already in. They got no money to pump in the market anymore. So you see the chart trading flat since the pump in the morning. And the question is, how sustainable is this rally if it's only happening overnight via pumping from the quote-unquote mysterious entity and not from retail and market participants buying during the trading hours? The answer is not sustainable for long. Moving on to the continuous contract, a daily chart of the SPY, and here it is. Finally, the break happens above the upper limit of the range. And the reason why I'm showing you the continuous contract instead of the regular SPY is to illustrate for you that the majority of the move today happened overnight via the continuous contract, not during the trading session. So is it a fake out? Who knows? But we need a confirmation tomorrow. Specifically, I'm looking for retail participation buying the market during trading hours. Moving on to the Qs, and let's see what's going on here. I'm highlighting for you the algorithmic pumps that took place yesterday during the first 3 trading hours, and today overnight. You see the pump in the morning and then going down. The volume keeps going down and down and down. And you see some retail participation here buying the Qs. Of course, the Qs has the tech names, the IPO names, the retail crowd's favorite names. So you expect to see a little bit of a pickup from retail traders. It's not good enough though. But all in all, the Q's managing to close above the support line of 308.50 and closing above the yellow trend line. You put that on the bullish camp. Moving on to the IWM. We talked about it in the intro, so we're not going to discuss it a lot here. But you know the story. The algorithmic pump yesterday, the algorithmic pump overnight, but it's not being picked up. When people say, oh, the market did not react yesterday, the world was in chaos, all the rioting and the occupying the state capitol and stocks are up. What's going on here? Not true. Take a look at the action from yesterday at the IWM. Retail traders did sell when they saw the images on television, but the selling pressure was not strong enough to overcome the power of the algorithmic pump. Enough said. Moving on to a daily chart of the IWM. What do we see here? The ascending line in momentum for the RSI continues to go in a higher trajectory. However, the challenge here for the IWM is to make higher highs in the RSI, signaling strengthening in momentum, but the downside for that is that you're going to get into overbought territory, meaning ripe for a correction. But the reason why I'm skeptical here, take a look at where the IWM is trading all-time highs. Meanwhile, it lost a lot of momentum from an RSI perspective in 2021. I think tomorrow and next week will be very critical for the IWM. Either we're going to see the impulsive rally and a surge in the RSI, perhaps above 75, going all the way to 80, or we're going to see a turn and you're going to see it right away in the RSI. And once we break the ascending trend line in the RSI, if that coincides with breaking the support line 191.5, that would be pretty much all the confirmation you need that the IWM has reversed. The mistake that I have done this week is I did not wait for the IWM to close below 191.5. I jumped the gun, bought the TZA the moment I saw the IWM piercing below 191.5. What is that? That is bear FOMO. It is just as good as bull FOMO and sometimes produce the same mistakes that you see in the bullish side. Moving on to the dollar index. One of the most important charts for the day. Everybody is not paying attention today. Nobody talked about the fact that we had a green day in the dollar index. Again, I maintain my position that we will see a short covering rally very soon in the dollar index. I don't think that the dollar index will decline in a straight line without having another short covering rally. Moving on to gold. What do we see here? Again, the dollar index rallied higher, and you see and you understand now why gold is the mature guy in the room. It refused to rally yesterday. It actually went down, predicting the green day in the dollar index today. You see gold being muted today, waiting in anticipation of what the US dollar is going to do. Moving on to the TNX, the Treasury yields. Once again, what do we see here? Once that energy from the consolidation below 1% is released, you see us gapping and popping higher, now well above 1%. At some point, that pop is going to run out of steam. We're going to start to go down. And the question is, are we going to test the support of 1% and bounce from it? That is certainly on the table. Now let's take a look at the TLT, bonds, weekly perspective. It is a descending channel. We are piercing below the descending channel. We were looking for a saucer bottoming. That is not happening, at least not yet. So we have to look down for the support line of 149. That is the line on the sand. Capturing support from 149, bouncing higher will mean the yields are retreating and we are seeing inflow back to bonds. However, breaking below 149 from a weekly perspective, which seems inevitable right now, will mean that we will see a further upward momentum in yields, which I know every Weisenheimer in Wall Street believes that that's good for the market because inflation will lead the market higher. It does in the short term until you realize that the risk premium is not worth it and you have to contract the multiples. Moving on to the VIX. What do we see here for the VIX? Critical day going back, and now we're seeing this wedge formation. Are you ready for it? Tomorrow is a put up or shut up day for the VIX once again. Every time we say it is a put up or shut up day for the VIX delivers, put up, and rallies higher. Tomorrow is another critical day, put up or shut up kind of day for the VIX. Either you're going to pop higher and keep the wedge formation alive, or you're going to break lower, and we're going to have to look at my line in the sand for the VIX. The 20 reading going below that means bye-bye VIX. Hello, another massive impulsive rally in equities. Moving along to Apple. Let's see what Apple did from a 15 minutes perspective. Rebound day, erasing all the rope-a-dope that happened yesterday, however, not closing above the resistance line of 130. What is the take here? Until and unless we close above 131, we're not going to see another rally in Apple just like we have seen before. The double top persists. Moving on to Tesla. Let's see what's going on here. Nothing new, breaking out over the upper limit of the range, and the sky is the limit for now, but keep close attention to the RSI. We're getting closer to my number of 84. If we get there, I'm going to join the bear camp and short Tesla. And perhaps we're only days away from doing that. Keep in mind that the stimulus money is going to buying Tesla calls. And let's move on to conclude this video by some questions and answers from the viewers. The first question, we kind of talked about this, but let's answer it directly. Do you think that the stimulus will move the market higher? Not really. The stimulus is already here, $600. You saw where it's going. It's going into the hotter names, Plug Power, Fuel Cell, NEO, etc. It's not going to be big enough to move the market higher. You already seen how weak retail participation in picking up, say, the IWM after the overnight pump. So the stimulus, most of it is already priced in, and when it goes to the market, it is going to go to pump the hottest retail names, aka the Robin Hoodie names, higher. It's a world that I don't want to dive in and look at all the tickers that they share on Reddit or TikTok, but sometimes I have to. I think you are more familiar about these Robinhood tickers than me. This is where the stimulus money is going to go. Question number 2. And this was a very long question, so I'm trying to summarize here. You say that the rise in inflation and the 10 years Treasury yield as a death sentence for the market. But isn't inflation also good for stocks? Now, you're kind of putting words in my mouth because I did not say it's a death sentence. I actually said it's a not death sentence for the market. But I did say that the geography of investing has to change, meaning that the rise in yields and inflation will benefit banks, financials, energy, materials, industrials, etc. But it will hurt the high multiple growthy names, specifically in the tech sector. And you are right that in the short term, the rise in the 10 years Treasury yield is often accompanied by a market rally. Why is that? Because everybody thinks that the rise in the 10 years Treasury yield is predicting an uptick in economic activity, meaning more spending from consumers in the economy, meaning again that some of that money will go into buying iPhones, laptops, Nvidia chips, etc. So you'll see the market in its entirety benefiting and rallying higher. However, you guys keep saying that the market looks forward. If the market looks forward, then it should see that inflation would rise out of control and the 10 years treasury yield would rally higher, making equities less attractive. Here is the last question of the day. And again, I read the question, but I don't know where I read it. Whether it's in Twitter or YouTube, I cannot find the question. Maybe the viewer deleted the question, but I wrote it down. And the viewer is pretty much asking if I have a recommendation for any miner or stock that represent silver, nickel, iron, etc. beside Freeport-McMoRan. I'm assuming that the viewer believes that they missed on Freeport-McMoRan and they're looking for another name. My favorite name is Freeport-McMoRan. Second favorite name is Vale. Now both names managed to rally impulsively since last year, so you're not going to escape that fact. However, my recommendation for you is why not buy an ETF, a mining ETF? And you got two choices here. Number one, the XME. This is the Spider Metals and Mining ETF. You also have another choice, which is my favorite. It's called PICK, the ticker PICK. And the reason is that this ETF is more global, more diverse, so you will get exposure to gold, silver, copper, platinum, iron, steel, global exposure. When you compare that to buying, say, Freeport-McMoRan, what if we have a problem specific to Freeport, such as a strike in a mine in Chile? Freeport will go down. But buying the ETF will minimize your risk from holding one name, and you will get exposure to a variety of metals and miners. Again, the ticker is PICK, P-I-C-K. This is the iShares Global Metals and Mining Producers ETF. What do we have? Tomorrow we have the big jobs report. We're anticipating and waiting for that. And my read is, if we have a bad number, the market is going to rally. Remember, we are in the video game market, the upside down kind of market, and we are expecting a bad read for December. A bad read, worse than expected, is not going to freak the market in my opinion, because it will actually solidify, say it with me, the supply of cocaine. Bad numbers in unemployment mean bigger stimulus and more easing from the Federal Reserve. And if we have an upside surprise, well, guess what? The market is going to rally too, because heads I win, tails you lose. The market would rally either way. That is at least my read, but I will be really surprised if we have a good number in the jobs report tomorrow and the market reacts as it should to the downside, not the upside, because the concerns of the supply of cocaine. That would be really interesting to watch, because it will poke a hole to the current narrative in the market that has been going on since last year's bottom. Good news, bad news, good news, worse news is even better news. Tomorrow is a very important day in watching the market's reaction to the jobs report, good or bad. That's all I got for you today. I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.